And in this conversation, you saw I called it making sense of making sense. It's not that you and Emil aren't.
We've watched many hours of your content. I think Nadiv watched every single moment of your content.
Not everyone, but I watched a lot of it. It took me like maybe 20 or 30 episodes just to understand what are these guys talking about. Like, what are they talking about? So hello and welcome everyone. My name is Nadiv Deutsch, and together with my friend Guy Galanti, we have the pleasure and the honor to host Jeff Snider for this episode. Jeff Snider is the head of global research at Alhambra Investments. I'm saying this just like Emil, huh? And no one says it as good as Emil. And we're really happy to have Jeff over. Like we spoke before recording this episode, Guy and I have listened to Jeff and Emil for many hours. We have learned much from their knowledge and from their experience. And I think the audience of this video or audio, any way you listen to this content, will enjoy this. So thank you very much for joining us.
Thank you for the invitation. It's my pleasure to speak with you guys all the way on the other side of the planet.
Yeah. So Jeff, I think the first question that I would like to ask you is, how is it that you became Mr. Eurodollar? How did that come to happen?
Totally by accident. This is not something that I'd ever expected as a career path, because I started out, almost 30 years ago, intending to be just a regular portfolio manager, buy, sell some stocks, maybe some bonds here and there. But very early on in my career, doing some equity research, I ran into, started picking through financial statements of the banks, especially the larger banks. And when you look at balance sheets of the larger banks, you started to think, something doesn't look, this is not the way we're taught, how money was supposed to work in school. So what is it these banks are actually doing? What is a repurchase agreement? And why are there so many of them? And so once you started seeing balance sheets and how they actually worked and how it didn't really match up to what you're taught in school, and then started asking questions of people in the industry, and most people were like, why do you care? This is not stuff that you're supposed, it's a .com era, everybody's making money. Why are you asking questions? Which really hid an underlying ignorance, which was really, nobody had any idea what was going on. And so it was sort of one of those things you put in the back of your mind and think, maybe somebody should look into this at some point. And you keep waiting for somebody to do some research. And of course, nobody ever did. And so, on my own spare time over the many years, it was sort of like, okay, let me dig into this. Let me dig into that. Let's answer what repurchase agreements are. Let's look into, securities for security, collateral swaps and things like that, and try to make sense of what's really going on here. And after enough time, you start to put together a more comprehensive view of what's really going on in the world. And so rather than be a portfolio manager, found out that, there is a genuine interest for actually this kind of a deep dive into how the world actually works. So now I exclusively do this type of research and, speaking with people and trying to educate them about all the things that I've uncovered over the last 3 decades or so.
Yeah, it's amazing. I think I've been following your content maybe for a year or so, and it feels like it's always growing, that there are more and more people interested. There are more and more people having conversations with you and Emil. And it's amazing to see, the power that YouTube has, really. Now, you said that during the 90s, during the .com bubble, I guess you're talking about probably the late 90s, you were starting to research this. I'm just curious, do you think that if people were more aware about this Eurodollar system, you think history would have been written a little bit differently? You think things would have come out a little bit different?
Yeah, it's possible, especially in the earlier part of the 90s. You get to around 1995 and after, maybe it was a little bit too late. Maybe things were inevitable at that point. But, ironically, it's, central bankers like Alan Greenspan in particular, throughout the 1990s, he kept saying, hey, we don't really know what's going on in the monetary system. And nobody paid any attention to what he was saying. Of course, he was not very good about speaking plainly. And oftentimes he tried to obscure everything that he was saying and make sure that it was all, hidden behind a mask of what he called Fed speak. But on the few occasions when he said, hey, we don't actually know what's going on in the monetary system, you would have thought that everybody would have said, wait a minute, what did he just say? Did he just say we don't know what's going on in money? But no, I mean, maybe if people paid attention to them, we could have said, okay, let's peel back all the layers of the onion and see what's really going on with these global banks. But then, there's always that political resistance where maybe people didn't want to know, because this is an offshore, outside the United States sort of Eurodollar system. It's its own currency and monetary ecosystem, the global reserve currency. Maybe there was this idea that, okay, we don't really want to go too far with it because we like the public believing that the US dollar is the US dollar. The Treasury Department and the Federal Reserve combined are in charge of the US dollar. Pay no attention to that offshore system that's outside of their control, because that could lead to all sorts of, that could open up a real can of worms. So even if there was, some maybe interest in examining the monetary system, I don't really know how far it would have gone, because there was very entrenched interest in maintaining the illusion that the US dollar is the US dollar. It's the same US dollar it's always been. The Treasury Department, the US government are in charge. And so let's not look at the Eurodollar system.
And I assume this was pretty simple for federal banks, for central banks, to do so in a time where the federal funds rate and the LIBOR rate were pretty much attached.
Well, that was, that's interesting, Nadeem, because that was one reason why they thought we don't need to look at the monetary system, because look at how great it works. It seems to be working fine. It's seamless. As you said, there's basically no spread between LIBOR and Fed funds. Now, federal funds are mostly domestic securities or domestic funds traded within the Federal Reserve's jurisdiction. And LIBOR, of course, refers to the Eurodollar rate, which is money, the short-term liquidity that's outside the United States. And with those two things trading together as closely as they were, you can see why central bankers stepped back and said, maybe we don't need to know the monetary details, because what we're doing seems to be working. And that was during the period where they called the Great Moderation, which was, okay, all of this money stuff seems to be working really well. Economic growth seems to be happening really well. It's very moderate. There's no inflation. There's no deflation. We seem to be hitting a sweet spot. And it wasn't just the US, it was around the rest of the world. So, it was almost like the mantra of, if it ain't broke, don't fix it. And so that's kind of how it happened. That's kind of where I came into this story, because it was like nobody wanted to look at the details, because it all seemed to work really well, even though there were some hints that maybe things were going on maybe too well. The whole dot-com bubble thing is one example. 1997, 98, the Asian financial crisis, LTCM, all that stuff. There was another example that maybe it wasn't as great as everybody thought. So, there was lack of urgency, because everything seemed to work well, even though, it's lack of urgency to the point where we don't even need to look at some of these oddities or some of these anomalies and understand that they weren't really anomalous at all.
Yeah. What do you, in one of your episodes, you spoke about Salomon Brothers. In the 1990s, they had the famous scandal where they were buying treasuries above and beyond what they were allowed, and Warren Buffett had to step in. What do you think those traders in Salomon Brothers understood during that time period regarding where the system is going?
Yeah, there's another perfect episode of, something else is going on here. We should probably look at that and understand its importance. And you're right. The Salomon Brothers episode was emblematic of this shift from, the more depository banking of the traditional, which you see in the textbook, to these wholesale relationships like repo or repurchase agreements that depend upon financial collateral, and not just financial collateral underpinning those individual transactions, a repo where you're borrowing funds, you're borrowing cash and posting collateral. But there's also another maybe even more interesting, more relevant layer to it, where collateral for collateral swaps take place. So what the traders at Salomon Brothers knew long before this was that collateral was it. That was the most money part of this wholesale system. And because there was a limited supply of collateral coming from the US government or coming from GSEs in the form of mortgage bonds, you could make a lot of actual money if you were the one who owned these, especially just auctioned off on the run securities. So what Salomon Brothers did was quite blatantly. I don't understand why they did this so blatantly. You would thought they would have made a more of an effort to hide what they were doing, but it was so damn blatant. They didn't care. They just bought as much on the run treasuries as they could to sort of corner the market on collateral, because collateral had become such. This is the early 1990s. This is 1990, 1991. Collateral had become such a big part of the global financial picture. They were quite stupidly, they were trying to corner the collateral marketplace because they had realized this is the essential or one of the most essential ingredients to the monetary system.
Do you think they were expecting some kind of liquidity crunch on collateral, or they were just quartering it down because they knew how valuable it is in the repo market?
I think it's the latter. I don't think they were expecting anything bad to happen. Of course, at that time, you also have to remember there was a switch over from, the savings and loan crisis in the United States sort of represented the death knell of traditional banking in the United States system. So you have traditional banking sort of declining because of the S&L crisis, and the entire system turning toward this wholesale end of things. The way the investment banks like Salomon Brothers or Goldman Sachs or Morgan Stanley, their business model. So Salomon Brothers understood in this structural change that was taking place, not just in the US, but across the rest of the world, how important wholesale money, especially collateral, would be in that basically structural monetary banking revolution of the early 1990s. And so their scheme was really about, if we own, if we're the majority holder of this, the best of the best pristine collateral, we can rent it out at exorbitant rates. So it wasn't necessarily expecting crisis. It was expecting, we see the value of these US Treasury bonds above and beyond their investment characteristics purely as a liquidity sort of a balance sheet tool. And so their thought was, if we own the best of the best collateral, we can charge high rates to rent it out. And of course, remember, we're reusing, rehypothecating, repledging. So it's not like it's just not a one for one. It really was sort of more valuable than cash at that time. And even it's at other times during the last 30 years too.
What was it that made collateral take such a significant part in the modern financial system in the late 90s, early 2000s? Why was it? What was that shift?
It's always about leverage. It's always about how do I maximize balance sheet space? How do I maximize my financial potential? And so what you're trying to do is, you're trying to reduce your funding costs down to as little as absolutely possible. So if you're going to do, if you want to do traditional depository funding on the liability side, deposits are expensive. There's also lots of regulations with deposits. Rather than doing a depository funding of your balance sheet, go into the repo market where you're borrowing overnight, so it's the shortest term, and you're collateralizing that loan, which means it's the safest, at least as far as the system is concerned. So if you're borrowing overnight using the most, posting financial collateral, the safest form of arrangement, you're incurring the least amount of funding costs that are absolutely possible. And so the lower you can get your funding costs, and the more often you can do that lower funding cost, the more leverage you can take advantage of on your balance sheet. So as this wholesale transformation really took hold, that was the primary motivation. Let's lower our funding costs by using what is supposed to be a very riskless or even risk-free transaction, because I'm borrowing cash on a collateralized basis. And so that's really, it's all about leverage.
Could you expand about that hocus pocus? Because if I were a bank and I have deposits at my disposal, how is it that I would get bad rates if I would use the deposits, and I would get better rates if I use the deposits to buy treasuries? Like, what is it here in the system that allows us to get better rates?
Well, as a deposit rate, you're paying the market rate for whatever depositors are demanding at that time. It's usually tied to some other short-term money rates, but usually there's a spread involved. And so, and again, as I said, there are also regulations and reserve requirements and things that go along with deposits that make them a little bit more expensive to use relative to whatever even on top of what interest rate banks are paying. Whereas in a wholesale, especially a repo relationship, you're going to be paying a lot less, depending upon the time period. I can't give you an actual number because it's different all the time and it's a dynamic marketplace. But by and large, if you're funding wholesale based on repo, you're going to be paying substantially less for your funding than if you were just to use a traditional depository fractional reserve type of banking. That's why that's another, one of the major causes of the S&L crisis to begin with was about a lot of savings and loans, these thrift institutions who were using deposit-based funding, trying to get involved in this wholesale model because they saw how much the investment banks were making. And so there was even before the S&L crisis started, there was a seismic shift underway to do this wholesale model because of the amount of funding leverage, because of the amount of regulatory leverage, the opportunity it presented banks to do so. So it was a much cheaper form, and it was thought to be a much less risky form of borrowing funds, funding your balance sheet, because depositors are people, they can be flighty, they can be unpredictable, whereas wholesale markets were thought to be utterly dependable and predictable, especially if you're using good quality collateral to make sure that all these transactions were backed by the best of the best things. So there was so many different advantages, or at least perceived advantages, to going to this wholesale model where repo and collateral was really the secret behind it, that by the early 1990s it was already a massive revolution that had already taken place.
So if we're really speaking about the 1990s and the early 2000s, what I understand is the repo market is growing quite rapidly. People are using in the repo market and reusing, repledging, the hypothecation of collateral, and not only that, they're using as collateral not only treasuries but also mortgage-backed securities. Yep. And the combination makes the repo market that's supposed to be the most secure, safe, liquid, safe and liquid market. It makes it much less stable. And when the subprime crisis comes about, that's kind of the prick that destroys the system. It's not so much that the subprime mortgages were the main problem of the global financial system or even the domestic American financial system. It was much more about the system is not using haircuts in the right way and are enough and really evaluating how safe a piece of collateral is, a security is. I would love if you can extend about that.
No, I was just going to say, you
say many times
nail on the head there. That is absolutely what happened, because during the 1990s, especially the late 1990s, you got to remember the U.S. government started running a surplus, or at least accounting wise there was a surplus, but at the very least the Treasury Department was borrowing less, which means they were issuing fewer securities. There was actually a shortage of U.S. Treasuries in the late 1990s for use as collateral. And one of the ways, and it wasn't just for this but one of the ways that the banking system got around that was they manufactured Treasury-like collateral out of mortgage bonds. Now, you think about what is securitization and what it's really for, and it sounds like, it's sort of this weird thing where Wall Street's trying to take advantage and fool people into buying risky securities. That wasn't what it was about at all. It was about, we have all of these billions and hundreds of billions of mortgage loans that are otherwise illiquid, just sitting there on a bank balance sheet, doing nothing other than, getting the mortgage rate and getting prepayments and things like that. Why don't we take these mortgage loans that are illiquid, we'll package them up in a really, quantitatively sound manner, and we'll essentially create liquid marketable securities from what were otherwise illiquid loans. And if we do it in just the right way, if we tranche things out, we carve them up, we give them the right gloss and right lipstick and the right makeup, and we put all this stuff on it, we can make some of these mortgage bonds that we're creating out of securities as riskless as a U.S. Treasury. And the thing was, back then, it was not as ludicrous and absurd as it sounds today, but some of that stuff really was, really good collateral. It was money good stuff that was going to weather all of, almost every market condition. And so the system said, let's take these mortgages and make collateral out of them. That way we can maximize our leverage, because now we have, instead of paying deposit rates and incurring all the regulatory nonsense that goes along with that, to fund these mortgage portfolios, we'll put them off balance sheet, we'll turn them in securities, and then we'll allow everybody to repo fund these securities or sell commercial paper against them. So it's leverage. And as you just said, Nadiv, it's exactly what happened. We had U.S. Treasuries that were limited in supply, supplemented by this rush of not just government-sponsored mortgage bonds, which are guaranteed by the government, but especially in the middle 2000s, a whole bunch, trillions of private label MBS that were treated as if they were U.S. Treasuries, especially in the repo market. So when you started to get the subprime crisis, where the housing bubble started to make some noises that things were starting to reverse, the system was just not able to withstand repricing all of that mortgage bond collateral, even just a little bit, because repricing and raising the haircuts in repo meant essentially, because everybody was so highly leveraged, you didn't have spare collateral to post when you were using, you were getting 99 cents in the dollar in one repo trade one day, and the next day your repo counterparty says, I'm only going to give you 95 cents instead of 99. You don't have spare collateral to come up with, which means you got to start selling assets, which contributes to more price volatility in those assets, which contributed to the this downward spiral where everybody is repricing, fire sailing, can't get funding. And that's really what became the global financial crisis, was the massive amount of mortgage bond collateral in especially repo markets and in collateralized transactions that were just beforehand treated as good as gold, as good as US Treasuries.
And if I understand correctly, from viewing this collateral is almost equal to US Treasuries, the haircut became enormous. It's like it went from 0 to 100 pretty much. No one wanted it. They treated these mortgage-backed securities, that some of them were actually quite in high quality. People didn't trust the system anymore because of these because of these subprime mortgages that were in these financial instruments.
Yeah, but that's the thing. It wasn't just the subprimes. Eventually, especially when you get into late 2007 or 2008, even the prime mortgage bonds were suffering too, because it was a liquidity event, which meant, remember, as a repo counterparty, you're the one lending cash and getting security. Okay, so put yourself in the shoes of the person that's lending cash and getting these financial securities as security for that transaction. All you care about, you don't care about the default probabilities on the loans. You don't care about correlation trade, none of that stuff. What you care about is you default on the cash. You don't give me my cash back tomorrow. I have to sell your security. And so all I care about is whether or not I can dependably sell your security. So I don't care if it's a subprime mortgage. I don't care if it's a US Treasury. All I want to know is if I got to sell it tomorrow, I can sell it and get back all the cash that I lent out. And so what happened with these mortgage bonds is that as they started to be doubted, some of it was subprime mortgages, you started to see some irregularities in those markets where dealers were stepping back and saying, they weren't even saying these are bad. They're just saying, maybe we want to take a little bit off the table here. But even that little bit had the effect of making the liquidity in those markets become a little bit less predictable, a little bit less reliable. And so as repo counterparties started to see that some of these, there's a little bit more price volatilities in some of these things that are not supposed to be volatile at all. Their price is supposed to be relatively stable. I got to adjust my haircuts to protect myself. So again, I don't care about the credit characteristics or the credit quality of the collateral. I only care that there's more volatility in these prices. And so I'm going to mark down your collateral you're giving me tomorrow, because I'm not as certain that I'm going to be able to sell it at the same price tomorrow that I did today. And so as those markets started to absorb that level of illiquidity, it then led to that self-reinforcing spiral where, the more repo haircuts were applied, the greater they were applied, even on prime mortgage bonds, the more that caused fire sales in the marketplace, which contributed to more negative volatility in the prices, which then forced, repo counterparties to raise their haircuts again. And so by the time you get to Lehman Brothers and AIG in September 2008, some of those mortgage bonds, even though they were not subprime, prime mortgage bonds, good quality collateral that had been given a haircut of maybe 2%, 1%, equal to treasuries, by the time you get to September 2008, some of them were marked down to 10% haircuts, which is just an enormous type of markdown in collateral that, the system just could not absorb. And then other types of collateral were just, some of the haircuts were advertised at like 30 to 50%, which is effectively saying you can't use this whatsoever. It doesn't matter.
Gosh.
I'm not taking it because I don't trust that I can sell it at a reasonable price.
I'd like to ask Jeff, I'm trying to understand the motives of the different participants in order to understand how this system works. So I would be happy if you could expand about which exactly are the parties that lend into the repo market and the parties that take the money, what type of transactions they use it for. Is it only money market funds that lend the money into the repo market, or is it other participants?
there is any number of participants, but you're right. And the cash side, it's largely money market funds who have lots of spare cash available that they want to lend safely, liquid markets, the short-term nature. So repo is a perfect place for money markets to invest their customers' funds. But it isn't just money markets. It's any, hedge funds can have spare cash that they want to go into repo. Dealer banks are often in repo, as are central banks and governments around the world. And then, of course, over the last 25 years or so, big companies are also, they're very cash rich. They have, a lot of spare cash that they're willing to try to get some kind of safe liquid return on. So you have all of these non-bank financiers in the marketplace. At the same time, you also have the same issues on the collateral side. So those that are borrowing that have collateral are usually trying to fund risky activities, whether it be hedge funds, whether it be other banks, whether it be dealers or whatnot. And so you sort of have a three-legged stool here. You have the cash-rich lenders. You have the risk takers who are willing or who are interested in finding funding. And then you have the collateral marketplace, which is, where do I get collateral? And so sometimes you'll have, say, a hedge fund that wants to put on a risky trade, and again wants to secure the most, the highest, most biggest amount of leverage that they possibly can. So, they'll buy a high yielding bond, let's say, a junk bond, a junk corporate or something like that. And they'll want to obtain the best funding for it, the cheapest funding for it. So you want to go into the repo market with a junk corporate because you'll get a high haircut and therefore you won't get as much funding as you need or the cheapest rate that you want. So you'll engage with a dealer bank to essentially perform what's called a securities transformation or a collateral for collateral swap, where you'll pay a small premium. You'll swap the junk bond for a US Treasury that the dealer bank probably borrowed from an insurance company or pension fund. So you have a collateral swap then that you have now possession of the Treasury that you're going to the repo market with. So you're a risk-taking hedge fund. You're funding this transaction that you're buying a risky junk bond based on a Treasury repo. So you've done a collateral transformation, you borrowed in the repo market, you roll over short-term using that US Treasury as collateral that you don't own, that's been reused already. And so what you've gotten for yourself is the maximum amount of funding financial leverage that you possibly can, even though from a systemic basis, it's not so simple as a hedge fund buying a junk bond. You now have cash counterparties who are securing their cash lending business with a treasury that's been borrowed from somewhere else. You have the hedge fund who's doing a risky transaction and using that risky security that's bought as the starting leg in a collateral for collateral swap or a transformation. And then you have the dealer that has to maintain the inventory of treasuries by continuing to rent them from, whether it's pension funds, whether it's insurance companies, whether it's central banks, any number of other collateral silos. So you have a very complicated process that, as long as it works really well, as it did in the pre-crisis era, it looks as simple as a US Treasury repo, and it's the riskiest, the most riskless thing. But you have all of these various counterparties who have varying different degrees of incentives to do all these things, because everybody is picking up a little bit of money, a little bit of a spread from all of these different activities, which are essentially just rearranging things in a particular way. So, the insurance companies and pension funds, US Treasuries are low yielding. Why not get a little bit extra return by renting them out to dealers? Dealers get a little bit of a spread on the collateral for transformation. The hedge fund is obviously making out on its junk bond being funded by the repo market. And then, of course, you have the money market funds or commercial paper investors that are looking for safe and what they perceive to be safe lending opportunities.
Yeah. So really, when this crisis really unfolds, during 2007. The Federal Reserve, when it came to Bear Stearns, it had a very different approach to later on with Lehman Brothers or AIG. I would like if you can explain a little bit what changed in the Fed that they gave a cold shoulder to Burr, while to AIG they were willing to be much more to come towards them to help them out.
Honestly, it was a lot of hubris. If you could break it down into a simple case, because it was a very complex period, and it was a lot of interlocking problems. But honestly, what happened was in March of 2008, Bear Stearns was essentially a failed institution, not because of subprime mortgages, but because it ran out of collateral. It had a margin call from JP Morgan that it could not meet because the collateral that it was posting, which were these mortgage bonds, got marked down so much that, in tri-party repo, JP Morgan as a custodian said, I think it was $6 billion in collateral tomorrow or you're done. And Bear Stearns was like, we don't have it and we have no way to get it. So what happened was the Fed kind of swooped in and said, ironically enough, well, let's get JP Morgan to buy Bear Stearns for $1 a share, whatever the price, I think it was $1 a share, essentially. And then not only that, the Fed after Bear Stearns, after what the Fed thought was successfully shepherding Bear Stearns from the brink of bankruptcy into a forced cold fusion, remember we called them cold fusion at the time, a merger with JP Morgan, they also realized what actually happened. There was a collateral shortage, and it wasn't just Bear Stearns. There were a couple other larger firms, hedge funds like Carlyle, that went before Bear Stearns did. So, in some level, especially at the staff level in the Federal Reserve, there was a realization that this was a collateral shortage event. And so the Fed came up with a couple different schemes. They had done Treasury, TAF, which were the short-term auctions of liquidity. They had done overseas dollar swaps back to December 2007. It was clear that those weren't working. So they came up with something called the primary dealer credit facility, which they thought would be, if Bear Stearns ever got itself in trouble again, they could take the bad collateral that JP Morgan didn't want and go over to the primary dealer credit facility window at the Federal Reserve Bank of New York and get their funding that way. So the Fed thought, we got this covered. Bear Stearns taught us, at least the lesson we learned from Bear Stearns was, we've got it covered. We know what we're doing. Okay, we did the TAF auctions. They didn't really work, but they're out there. We've got this primary dealer credit facility. There's a couple other programs they came up with too that were just a similar idea, where the Fed thought Bear Stearns was the bottom. It was a low watermark for the system. The Fed figured out how to maintain sufficient liquidity and function using collateral swaps and things like that the real system had been using for decades. They thought they got themselves up to speed. And then by the time we get to the fall of 2008 with Lehman Brothers and AIG, they thought, we got this covered. So we'll let Lehman Brothers go because we've got the primary dealer credit facility. And you can see this in the email traffic back and forth between some of the Federal Reserve policymakers and even, JP Morgan, which was saying, you guys don't have nothing covered here. This is going to be a big deal. And they were like, no, we got this. You'll see, we're good here. So the difference between Bear Stearns in March of 2008 and by the time you get to Lehman Brothers and AIG in September is the Fed really thought they had done it. We've got this thing covered, even though throughout that 5-month or 6-month period in between, there was any number of warning signs, including confidential internal traffic, email communications and whatnot, but even market warning signs that said, this isn't covered at all. You guys have nothing. So the Fed thought they had everything, put together, and the market said, man, this is going to get bad if something ever does happen because these people are out to lunch. Well, so that's sort of the short version of what
I'm trying to understand what prevented the central bank from being the lender of last resort. If Bear Stearns was low on collateral, okay, you can swap it with cash, which is obviously just as good or better than collateral. That's what the central bank is for, right? Why couldn't the central bank just simply print money and give it to Bear?
Because the system, again, is so complicated and so intertwined. It's not a matter of let's break it down into individual transactions. It's not like we can say, okay, Bear Stearns is using $100 million note that is a prime mortgage bond, and they're going into the marketplace and getting $99 million in collateral. Why can't they just replace that transaction with the Fed? Well, they can, but it's all of these different counterparties and all these different dynamic relationships between pension funds and insurance companies and dealers repledging, reusing, rehypothecating collateral. It's hedge funds who are linked to the dealers, but also the marketplace. It's money market funds who are saying, this used to be very easy. This used to be the most boring stuff ever. And now we're getting hit and bombarded with all of these potential problems. We're seeing these markets go haywire. So it's not as simple as the Fed coming in and just saying, we're going to give you currency. What kind of currency? And there's other parts of the story that we haven't even touched, like credit default swaps and how banks actually manage their balance sheet capacities, and how credit default swaps are actually a price input on these mortgage bonds. So it's even crazier than what we're even getting into here. And so the Fed was like, all right, we've got the primary dealer credit facility. Bear Stearns can come over here. that only solves like this much of the problem when it leaves this much of the problem left, which is this dynamic marketplace with these intricate sets of, as the BIS said in 1964, long chains of liabilities where you have all of these potential fault lines that go along as that can come about in any place along those liability chains. So it's not like it's, we're just funding individual transactions. We're running dynamic portfolios that are they're interlocked between all sorts of different parts of a financial system. Let's not forget that this financial system isn't just domestic US, it's also outside the United States too, where the Federal Reserve has no jurisdiction to do anything. So we have a global problem, we have a dynamic marketplace, we have interlocking problems that are all over the place, and they don't really take on the familiar, it's not like a bank run from the 1930s where depositors are switching their deposit liabilities into cash. It's interbank problems where we can't really identify what it is that these banks are doing with each other that are causing all these problems.
You mentioned and you speak a lot about the difference between the Eurodollar system, between the dollars that are used outside of the US and the system in the US. And it seems like in 2008, the system did manage to avoid a total meltdown. Like there was, you may explain differently, but what was the difference or what was the collateral damage in the overseas system that makes it act in a different way now, in a way that is maybe suboptimal, as you say?
Well, I would argue that it was as bad. It was a total meltdown. It was as bad as it was going to get. I don't buy the argument that the Fed saved, the job saved argument where the Fed came in at the end and said, well, we didn't prevent the thing from happening, but at least we kept it from being worse. I don't know how much worse it could have been, because not just the United States economy had its worst economic circumstances since the 1930s. It proved to be a permanent shock of which we haven't recovered from. And that was just the US. So it was as bad or worse as other parts around the world, and Europe in particular. Europe got really hammered because of so much of the cross-border funding relationships, cross-border debt and credit relationships, and everything else. So it was a total global meltdown. It was as bad as it could possibly get, which is,
but it didn't become a depression or a depression.
I would argue it did.
Yeah, we'll get to that in a moment. But it didn't come to be a deflationary depression like we've seen in the 1930s. It didn't get to be that bad.
Well, yeah,
it probably could have.
If you stack US GDP or European GDP today over the last 15 years, the immediate period after 2009 to say 2018-19 with the 1930s outperform.
Yeah.
Yes, we are worse than
still,
the Great Depression.
People aren't standing in lines for a piece of bread and
that's just nothing more than a large safety net that exists now compared to before. But in terms of actual private economic activity, we didn't have nearly the same level of depth of the bottom, of course. And it wasn't like wholesale prices are collapsing by 40% like it was in 29, 30, and 31. But, by and large, even though it was a shallower contraction, the lack of recovery, especially over an elongated period of time, ends up being the far worse consequence. So I would argue that, the total meltdown we did have in 2008 was in many ways worse because of how long it has gone on. And so whereas we finally got ourselves out of the Great Depression in the 1930s with at least somewhat of a limited recovery, this has been a completely upending the entire global economic case, where global growth since 2008 has been completely rewritten and completely changed, and we're living with the consequences of it. So I'm not saying, it was as bad as the Great Depression. What I'm saying is that it's in the same category. And because it was in the same category, I look at how the 2008 crisis evolved and what it actually meant very differently. So I consider that a total meltdown, even though we didn't have the sharp downturn like in 1930 and 31.
Could you expand about that that current depression kind of, or that current suppressed level of activity? Like, what is it in the current financial system that you think could function better, could work better, but just doesn't do it?
Well, for one thing, it's the collateral shortage, right? I mean, because we had all of those mortgage bonds that were treated as good as treasuries and priced and valued as treasuries, given the same haircuts before the crisis hit. Since then, nobody gives mortgage bonds the same look as they used to. So already we have an enormous amount of collateral that has been permanently repriced, which has created a shortage of collateral. And we're not making as much of those mortgage bonds collateral through securitization. In fact, they're not making nearly as much as they had before the crisis. So we're not manufacturing collateral. We're not valuing mortgage bond collateral the same way. And then we had the European sovereign bond crisis in 2010, 2011, which eliminated a whole other class of collateral from the top tiers. So ever since 2007 and 2008, the collateral list, the best of the best collateral, the list of issuers on that, the names of issuers on that list has been shrinking and shrinking and shrinking, which herds more and more people into the best of the best, whether it's U.S. Treasuries, German bonds, JGBs, those types of things. So, in a very top level answer, we have a collateral shortage that started in 2007 that we've never solved. Even as the U.S. government has gone crazy borrowing money and issuing treasuries, it still doesn't substitute for that dynamic marketplace where the system manufactured as much collateral as necessary. So one of the key problems as far as the disinflationary drag on the global economy is that we have a lack of collateral. But the bigger picture in the Eurodollar system, why we have this constant deflationary presence, is lack of balance sheet fluidity, lack of balance sheet capacity, because that's really the money here. There are no such thing as Eurodollars. It's not like there's these, outside the United States stacks of cash. It's all ledger money. It's all banks keeping track of who owes what to whom, and therefore expanding their operations means expanding the monetary system. And ever since 2007, 2008, banks have not expanded. I think that's another popular misperception, is that with the Fed doing QE or banks or central banks around the world doing a lot of QE, it's been a great time to be a banker. It hasn't. And a lot of banks have actually shrunk over the last 15 years, and the banking system as a whole has only grown by a little bit, which in a dynamic nonlinear world that we live in, lack of growth, even if it's actual somewhat growth, but lack of the different rate of change or a lower rate of change actually means contraction. So bank balance sheets are constrained, which means they don't create the money. Collateral is part of that too. So overall, we have this banking system that changed from the way it used to be to what it is now. And the way it is now is it can't go back to the way things were, because we've realized that the inherent instability in that Eurodollar system, not just collateral, but all of these other things that go into bank balance sheet management.
Do you think in the US things are different? Do you think that because in the US the Federal Reserve actually does control at least the federal funds rate, there is more liquidity and there is more expansion of the economy than what is reserved for the rest of the world?
Yeah, no, I think the Eurodollar system isn't really that much separated from the domestic system. It really is a dynamic whole where the domestic U.S. part of the system, whether it's federal funds or whatever the Federal Reserve is doing, is sort of a subset of the Eurodollar system as a whole. So there isn't a bright dividing line with the U.S. boundary where there's the U.S. domestic dollar and then there's this offshore Eurodollar. They're mixing it up all the time. But you're right, there is definitely, the U.S. economy has by many metrics outperformed the rest of the global economy, simply because I think it's one reason is that we had the bond market. The U.S. isn't as heavily banked as it is around the rest of the world. For example, the European economy is almost exclusively dependent upon banks for money and credit, where the U.S., especially in 2009, that made a huge difference, where companies that were shut out of commercial paper, couldn't go to the Fed, could issue bonds that the bond market was willing to buy. So there was a more sort of a dynamic marketplace in the U.S. for funding and credit and debt that I think benefited the U.S. economy greatly. There are also some other benefits to it too, but I don't think it's the Fed. I don't think that's really the reason. And I think structurally, the European economy, contrasting those two in particular, had a lot of various structural faults, inherent problems. The differences between the southern states and northern states, don't need to get into that, but the European economy was far less pliant to be able to come out of the 2008 Great Recession in the same way that the US did. So the European economy underperformed for a lot of other reasons too, including the fact there wasn't as big of a bond market working around there. But overall, the monetary system is the monetary system. It's there's various pieces to it, various national parts to it, but it really is stitched together, is really linked together by these global banks.
So I think I heard you once say that prior to the financial crisis, there was a certain trajectory for global growth, for GDP growth, domestic growth in the United States. And that trajectory never came into place. It was not a V-shaped recovery. It was more like an L-shaped recovery, and it just stayed that way. If you can please expand about that, I'd love if you can expand about that.
Yeah, we never recovered from 2008. And by we, I mean everybody. The entire world economy fell off in 2008 and it hasn't gone back on. And it's funny, in the US, you can link it exactly to the worst parts of the financial crisis. Like, for example, the labor force fell off. The labor force isn't supposed to contract, because if you lose your job, you don't leave the labor force, you look for another job. So you're actually part of the labor force. But the first time in the post-war era, October 2008, the US labor force starts to shrink, which was a very key indication that, hey, something's really wrong here. We don't have to, go looking for answers. I mean, October 2008, it was pretty obvious what was wrong at the time. So we have a monetary crisis that affects not just the US economy, but affects the entire global economy, which you would expect, because when you realize the Eurodollar system is really the global reserve currency, if you have a problem, a very big problem in the global reserve currency, that's going to be a big problem for the global economy. Not just in terms of merchandise trade, shipping goods back and forth all over the place, but also financial flows, because financial flows intermediate through the global reserve currency too. So if you're in, say, if you're in Israel and you want to invest in Singapore, you're probably going to transit through dollars too. And if dollars are hard to come by, you're not going to have the same ability to the global financial flows are not going to have the same ability to move back and forth as we need them to be. So what 2007, 2008 represented was a permanent rupture in the behavior of the global reserve currency. That doesn't mean the global economy shuts down, but it means the global economy becomes more inefficient. It becomes more inelastic. And that creates a problem in terms of maintaining the same level of global growth as we've been able to achieve before the global financial crisis. So in very simple terms, the fact that the global reserve currency experienced a permanent shock in 2007 and 2008, you would expect the same thing to happen in the global economy. And global trade, merchandise trade is a perfect example of this, where you see it has never recovered. And so you have all of the spillover effects from one country to the next, and throughout the rest of the world too. So it's not just the US economy that hasn't been able to recover. The entire global economy has been forced into a very different state of affairs, which, taking it outside of the macro context or outside the money context, it has led to this trend, even before COVID, of de-globalization, where everybody's sort of taking, before we used to cooperate because it made sense. Everybody seemed to be growing and getting benefits from this close contact and more cooperation, more trade. Since 2008, it's not the same at all. And so it's kind of everybody's in it for themselves nowadays, which makes a lot of sense when you put all these pieces together.
It really explains what we're seeing in the days that we're recording this video, this conversation, with what's going on with Russia and China and the US and Europe. It makes a lot of sense when you see that people aren't their level of well-being maybe is not improving in the rate that they would want it to. It causes a lot of tension. I think also social tension. I know where we live in Israel, there's a lot of social tension between people who haves and the have-nots. I think in America we see that with growing homeless. Things are definitely changing that we didn't see in the past. The streets of Los Angeles full of homeless people. Things are definitely changing in that aspect. Guy, do you have any question about that?
Yeah, certainly. So I would like to understand if we have a suppressed level of financial activity, from what I understand, it comes more from the supply side than from the demand side. Like you say, people want to act in dollars, people want to do financial activity, but we find it hard to get the financing for that in dollars. Like, is that correct?
Yeah, that's part of it. And you can see the various, since 2007, 2008, it's, we've had various periods where we see renewed dollar shortages where dollars become very hard to source. Dollar, collateral becomes very scarce. And so ever since then, we've had these repeated cycles where we go into these dollar shortages, which suppresses activity. You want to trade, you want to invest in countries around the world, you want to invest in different places, but yet you go into the dollar system and suddenly, the dollar, the effective cost to intermediate through the Eurodollar system becomes too much. It becomes too high, so you don't do what you might have done before. It becomes too much of an inefficient situation where global growth suffers for the lack of efficient flows in the global reserve currency.
Why do people need a lending facility in dollars? If I am a financial actor, if I am a company, what would prevent me from borrowing money in my own currency and exchanging it in the Forex market and maybe hedging that? Or what would prevent my bank from doing the same and providing me with these dollars? Why is there a dollar shortage when there is such an efficient Forex market that is used for many different needs?
You're getting into the real nuts and bolts behind a global reserve currency system. And what is a global reserve currency? Its function is to be everywhere. It's to be the currency through which everybody intermediates. So if you're in, say, Israel, and you want to do some kind of financial transaction with some place around the rest of the world, there's absolutely nothing stopping you from borrowing shekels from the Israeli central bank or some bank in Israel and saying, oh, I've got funds. But if you're going to transact with a company, say in Japan, to import some goods, they don't want your currency. It's no good to them to have Israeli currency in Japan, but they have lots of use for US dollars. So you want to transit through the US dollar system. So you want to swap your local currency into the US dollar intermediary, because then it could be exchanged either for, the Japanese company can accept the US dollar transfer because they have use for dollars, or they can easily be swapped into Japanese yen. So the US dollar becomes the medium by which all of these things intermediate through. But if we have a problem where, say, the Japanese bank maybe doesn't want to, or maybe can't get the dollars, or you can't swap out of the Israeli currency into the US dollar at the rate that you want because US dollars are hard to come by, that stops this whole transaction immediately. There's really no other way to go around it, because you have a local currency that's very useful to you in your local jurisdiction, but it is not useful at other places around the rest of the world. And if there isn't the same market function, whether it's in the forward markets, the swap market, or just basic useful currency swaps between in the interbank spaces, if you're not able to get the same US dollar terms as you had beforehand, or cheaply enough that allows you to do these transactions, it causes a major drag on economic activity. Because what are you going to do? You have no other way you've got Israeli currency, you have no other way to transact in the global marketplace. You have to go through the dollar system in order to be useful outside of that local currency jurisdiction.
So what would the thing that would prevent me from doing financial activity? Usually when a business acts, it has profit margins that, I don't know, they differ from industry to industry, but they're usually within, I'd say, roughly 3% to 10%. Some have more, some have less. Would the transaction costs of changing from shekels to dollars to yen and back, could that be so high to make it unaffordable for me, not worthwhile to pursue my business interests?
You can imagine if you said, okay, the bank won't give me reasonable dollar terms, I'll just call up Japan directly and say, I'll pay you a premium in shekels. And so the company in Japan might say, well, that premium is going to be enormous because, again, I don't have any use for shekels. So right away, you could work around using local currency, but the costs are going to be prohibitive. And it's kind of the same thing for these interbank marketplaces where, the bank that you might be transacting with, the correspondent bank your Israeli bank might be transacting with, says, I'm really uncertain about borrowing or buying and selling dollars in this marketplace, so I have to mark up all of these transactions that go from you to me to the Japanese side of things, where it makes the cost prohibitive. And it can be so prohibitive that the US bank or the Eurodollar bank says, it's really not worth it for me to transact on your behalf because, you know, maybe there's not enough collateral in the system and in the repo market isn't functioning the way it should, or, you know, just on an unsecured basis, that market doesn't even exist anymore. And so you're into the forward marketplace, which has to be collateralized too. And maybe the prices there are overwhelming. Maybe the perceived volatility is too high. So the Eurodollar bank says, yeah, I can do this transaction, but it's going to cost you a lot too. So without this fluid function, without this useful, predictable function in the Eurodollar system, it really can be the case where commercial agents are robbed of profit opportunity for lack of monetary resources.
Yeah. Let me go back to our days now where I'm actually, I have COVID. I'm locked at home right now. So it took me 2 years to get it. So it's good. 2020 was a tough year for the global economy, from financial markets. You said more than once that you believe that the downturn that the economy took during 2020 has less to do with a global pandemic and more to do with global systemic liquidity issues, going back maybe I think to 2018, where the yield curve inverts. I would like if you can expand about that topic.
Yeah, we entered the 2020 recession maybe even in a global recession. We'll never know because the timing was so coincidental. You know, you get to late 2019, there was definitely a manufacturing industrial recession throughout the rest of the world, including the United States, where you see production levels had fallen off substantially. Labor markets were still relatively stable. Europe was sort of questionable, but I think by and large, we entered 2020, even before COVID, with a mild global recession. Maybe it would have gotten worse. Like I said, we'll never know. So we started out the 2020 pandemic with the economy already in the toilet. The global economy was already doing really poorly. And that includes the Chinese and includes emerging markets in various places around the world, which, I mean, the last thing you want to do is have a fragile situation impose upon that an even larger artificial or non-economic constraint, which can potentially have the effect of making bad things into permanent bad things. You can have businesses that were suffering because they were in a recession before the COVID, and then you shut everything down and they're like, we can't survive this. And they just close their doors completely. And that's really, not only that, you have the recession starting at end of 2019 into 2020. Then you have governments shutting the economy down. And then on top of all that, you have this financial meltdown. Now, I know the Federal Reserve and the financial media are going around patting the Federal Reserve on the back for its performance in March 2020, which is just laughable. I mean, 2 years ago today, the Fed announced its massive QE, which was a Sunday night, March 15th. And the day afterward, on March 16th, the global stock market melted down in its worst single day in decades. So we have this global financial crisis that showed up in March 2020 on top of governments shutting down the economy, on top of a recession that preceded the pandemic. And it's a recipe for really another permanent shock to the global economy, a permanent shock to the monetary system, basically a permanent shock to everything. Because let's face it, were we really expecting to go through all of this historic stuff and come out the other side with no damage to it? No, there was going to be some permanent damage, and it's been papered over and covered over by everybody's focus on consumer prices and CPIs, which were really a nod to how this is really mostly a permanent change in the economic shape and economic potential. Another one, the second one after 2008.
Would you not say that fiscal stimulus that came from the government side was actually very beneficial for the economy to help businesses that were suffering anyways because of this recession that has begun, to go through these lockdowns through this difficult time, and actually provided the market with the inflation, the liquidity that it needed to get through this crisis? I'm not talking about the central bank right now, which was obviously monetizing the debt, but I'm talking about the governments who actually put their hand into the pocket, into their wallets, and gave money straight, directly, not through the banking system, straight to people's pockets, so people can go and consume.
There is definitely an economic case, as well as probably a moral case, for what the federal government in the US did and what other governments around the world also did. They all did different things, but by and large, that was the intent, right? Was that we can't go through the banking system because that isn't going to work. So let's directly deposit cash, or let's directly deposit something in, whether it's a business account through grants or loans that became grants, whether it's a individual's account through in the United States we had these helicopter payments. So there is definitely an economic case to be made that was absolutely necessary to prevent something even worse from happening. The issue isn't so much that as it is, what is the longer run benefit from doing that? And really, that's where it gets into the gray area and becomes more of a debate, more of an argument, because there's a lot of people who presume that once that was done in 2020 and 2021, it would lead to all these knock-on effects, these positive second and third order effects, where you would have stimulus leading to more economic activity, lower economic activity, and so on. And that's where the inflation came from. When in fact, that's not really what happened at all. You had this one-time dose of fiscal stipends or fiscal assistance that shifted the demand curve in the United States as well as other places around the world to the right temporarily. And eventually, at the same time, this, as I mentioned before, the supply curves were totally inelastic because companies were shut down, companies were suffering, many companies never reopened. And so you had a temporary shift in demand based on, Uncle Sam in the United States and other places, other governments around the world, which had more demand for the system's ability to supply fewer goods, which meant prices had to adjust upward, which they obviously did. And then you add into that the complications from, moving goods from one place around the world to another, including dollar difficulties along the way. It was a recipe for consumer prices to go higher. But that wasn't the same thing as a recovery. And I think that's what you're really trying to ask here, and what you're really trying to get into was, did these fiscal interventions create the seeds of actual economic recovery? And I believe the answer is no. I think it was a temporary one-time effect that actually may have caused, in the long run anyway, more harm than good. Now, maybe it was necessary to keep people afloat. Maybe it was necessary to keep people from really shutting down. There's an argument to be made for that. But over the long run, I think you're seeing, especially now with the way markets are behaving in 2022, that we're facing the prospects of a global economic reversion that may be harsher than most people are anticipating, because they thought the government had created a recovery, that these fiscal interventions had created a full and complete recovery, when I think what they actually did was disguise the fact that we had actually gone through another one of these L-shaped periods after 2020, that we did actually absorb quite a lot of permanent demand, or a lot of permanent economic damage that has reduced economic potential even more than it had been reduced since 2008. So it's sort of this situation where the government activity sort of obscured what's really going on. And I think this is the year we'll start to see the real economic baseline potential show itself.
I think the topic that most people have been talking about mostly in the last year is really inflation, or the rise in consumer prices. Milton Friedman obviously said that inflation is always and everywhere a monetary phenomenon. I would love if you could maybe explain a little bit the difference between rising prices and inflation, and in what way do you agree with Milton, and where maybe would you diverge from his explanation?
Well, his simple phrase is one that he came up with in 1963 or 1964, I forget which year it was, which was the year he wrote A Monetary History. So when he said inflation is always and everywhere a monetary phenomenon, it wasn't just some crazy idea he had that he was working on. It wasn't just something he spitballed or threw against the wall hoping it would stick. He had just gone through the monetary history of the United States, as well as, in his own other academic work, going through inflationary periods throughout the rest of the world. And it was always and everywhere a monetary phenomenon. So yeah, you have to agree with what he said, because it's historically validated in every case around the world. If we have an out of control monetary situation, you're going to get out of control consumer prices, or asset prices too. You might get both of those things. Now, this distinction here is that consumer prices can change for other reasons that are not necessarily tied to the monetary system. We've seen this historically all time and time again, not in the Eurodollar era, but before the Eurodollar, in 1950 and 51, 1947, 48, and 49, where we had consumer prices skyrocket for reasons that had nothing to do with monetary printing. 1947-48, for example, post-World War II, Europe wasn't quite rebuilt, but yet demand for goods started to come back before the supply was available. And so global supply was unable to meet this tremendous uplift in demand. And so consumer prices in the United States were rising at a 20% annual rate at one point, and double-digit annual rate for almost 2 years. But that wasn't inflation. That wasn't money. That was simply a supply shock. Again, in 1950-51, we had the same case where consumer prices accelerated at a double-digit clip. I think in 1 6-month period, it was almost a 15% rate, not because there was excess credit or excess money, but because of the Korean War, where Americans realized that the US entry into the Korean conflict would mean a restriction in consumer goods. And so Americans went nuts and bought everything they could possibly get their hands on before the government shut it all down and started rationing things. So you have inelastic supply versus a shift in demand, not inflation. And the real key difference here is not just that the money difference in the background, but if it's not money, if it's not real inflation, it's not going to last, because at some point those price changes become destructive, because you're essentially redistributing income, you're redistributing profits, you're redistributing economic activity inefficiently toward the wrong sectors. So in our current period, we're paying a hell of a lot more for oil and gasoline, that's economically harmful. And if this was monetary inflation, we would see inflation at the same rate or better rate outside of just those narrow sectors where the supply curves have been most inelastic. And so because of that, we're expecting that oil prices that have risen, some consumer good prices that have risen, especially in cars and automobiles, those are going to be temporary. And eventually, if they continue to be a problem, they're going to be a problem in terms of overall global economic demand too. So consumer prices can rise for other reasons that have nothing to do with the monetary system. But if they do for other reasons, it's not going to be the same as inflation. It's not going to be sustained consumer prices year after year after year after year. It's going to be for some period of time before it eventually the consumer prices of the global economy reverts back into its previous state.
I would say that if prices increase, not because any monetary system, just because a lack of supply, then if oil costs me more at the pump, I will pay less at restaurants or hotels or any other services in the economy. So it flattens out. Those hotels and restaurants will reduce their prices. I'll go more for restaurants and consume less oil, and prices will go back down. The chair of the Fed said that inflation is, how did he call it? He called it that it was temporary, right? That he said that it's
transitory. Yes,
transitory. So you actually agree that what people call as inflation, you say it's not inflation. You say it's these price rises are transitory, but it's not inflation.
Yes, I start by looking at the monetary system, which is very difficult to do because we can't look at the monetary system directly because it's this global Eurodollar banking system. You can't just say, what's the Eurodollar doing today? You have to piece it together from all these market prices and behavior and certain data. But when you do that, what you see is that there was no money printing at all. In fact, if we read these curves right, if we read these market prices right, there was so much monetary destruction in 2020, we're still trying to climb our way out of that hole. So it's not monetary, it's not the monetary variety of inflation. What else has it can only be the other type of inflation. So the monetary system, the money isn't there. And so, yeah, you're exactly right, Nadeem. I mean, we're spending more on gas, which means we're spending less on going out. And in the United States, in particular, the US economy, that dichotomy is so obvious and so visible because US services spending hasn't even gotten back to where it was in February 2020 on a real basis, on a volume basis. Whereas, spending on goods has gone through the roof. So we spend a hell of a lot more on goods that are priced exorbitantly high at the expense of the services economy, which is one reason why the US economy as a whole hasn't actually recovered from 2020. Because while we're all focused on goods and the price behavior in goods, nobody notices how bad it is on the services side, which is probably where a lot of that demand destruction from the 2020 pandemic and government response actually came into it, right? Because we shut down bars and we shut down restaurants, we shut down the services part of the economy, and a lot of those small and medium businesses are never coming back. And so we're starting to realize that this imbalance actually did take place in 2020. And despite all the focus on consumer prices and the goods economy, the overall shape of the whole economy is hardly inflationary at all.
Yeah, we have really seen throughout history that every time that there is a hike in oil prices, it's followed normally by a recession. Is that where you expect that we're heading to in the coming months or coming years?
The probabilities are rising. It's tough to say, hey, it's absolutely going to happen and when it's actually going to happen, but the markets are absolutely pricing for that scenario as a non-trivial chance. And I would argue that it's probably a lot higher than maybe most people are expecting. You see the yield curve sort of inverted and flat. Eurodollar futures are really inverted, which is a really kind of a pessimistic sign. This massive, deep liquid marketplace is hedging against something that would happen that would force the Fed to stop hiking rates and maybe turn around and start lowering again. What kind of scenario would that be? That's kind of consistent with a recession or some form of serious downturn. So markets are already saying that there is a high degree of probability something like that happening in the maybe not too distant future. Can't put any more specifics on it because that's not how this works. Yeah, but the probabilities are starting to stack up in that direction, which, as you said, makes perfect sense. When we look back through history, you see, especially oil prices in the modern economic situation, energy costs go up. It's usually too much for any economy to handle. And ironically enough, that was the situation during the great inflation of the 1970s. You had this existing inflationary, because we had excess money back in the 70s. You had this existing out of control inflation, not just in the US, but around the rest of the part of the world. And then in 1973, the oil embargo related to the Israeli Arab War.
Yom Kippur War.
Exactly. We had the oil embargo that shot up oil prices in the middle of that inflation that caused a recession to happen while we were experiencing the monetary variety of inflation. We had both of those things at the same time. So 1974 into 1975 in the US was a really nasty recession because of the oil price shock that started in late 1973. And adding to the misery of that was this out of control monetary situation. So you had inflation and recession at the same time. Now, I don't think we have that now because we don't have the money for it, but we do have an oil price spike, even though the oil prices have come down over the last few days. Even in the United States, WTI up around $100 is probably too high for the U.S. economy to handle. Brent being about 110 in Europe, that's probably way too much for Europe to handle. So we have fragile, weakened economies that are trying to work their way through another oil price shock, which is why markets are tipping, their hand that, there's a high recession probability at some point in the near future.
Yeah, it seems to me that Jerome Powell never really changed his mind about inflation being transitory. I actually doubt that he really sees it as inflation. And I think that one of the things he was hoping for a few months ago was that if the wealth effect goes down a little bit, people feel a little bit, that their stock market portfolios, their equities are worth a little bit less, they will consume a little bit less, and there'll be less transferring of money, and inflation won't be created. I think one of the things that the Fed was actually worried about is that this situation that has nothing to do really with inflation will actually change people's mindset to worry about inflation and start behaving accordingly. Do you agree with that?
Yeah, I agree with a lot of what you, in fact, I think I agree with everything that you just said, because number one, to start with the fact that Powell and the Fed said that inflation last year was transitory because they realized it was a supply shock, and that's exactly what it was. And they haven't really changed their tune on that, because even though they're getting into more hawkish and rate hikes and tapering QE this year, that's not because they think last year was transitory. It's because they're worried about the effect of last year's transitory price behavior on future price behavior. And so you're right. I wonder if if they're discussing at the FOMC right now as we speak, if they're actually talking about whether or not the stock market coming down will dampen consumer spending, which is the primary source of that supply shock to begin with. And let's face it, consumer confidence has gone into the toilet in the United States and in Europe and other places around the world. Consumers aren't very confident at the moment. If that confidence becomes less spending, that would take an enormous amount of pressure off of the supply shock, because there would be less goods to move through, ports that are congested. It would mean also, less demand for whatever elasticity and supply. So the Fed might be saying, yeah, this is less inflationary because the stock market's down and things, whatever. But I also have to believe that the Federal Reserve in particular, to a certain extent, the ECB too, are under enormous amounts of political pressure to just appear to be doing something. It doesn't matter what you do. Politicians are going to be like, you need to get on TV tonight and say you're doing something about inflation, because that is everyone's biggest topic. That's what everybody's talking about. That's what's going to kill the Democratic Party in November if it continues. And so I think the Fed, whether or not they think about inflation in those terms, and whether they think that lower stock prices and low consumer confidence might actually help, I think they're going to continue raising rates because of the enormous political pressure anyway. But you're right. I think, as far as what their actual belief, or what the stated, what they actually think is happening in consumer price in the U.S. around the rest of the world, I think it's more along the lines of that there's less pressure today than there used to be.
Yeah, I feel like if they pursue this action of raising the federal fund rate, I'm not talking about the tapering that we all know that it's a bunch of noise. If they actually raise the federal fund rate while prices of everything are going sky high, and we don't know how long this conflict in the Ukraine will go forward, and the consequences on China, etc. The Federal Reserve might be creating a huge financial downfall that didn't necessarily have to happen. Would you agree with that?
Well, I think that where their effects are most visible, most prominent, are on the stock market. And so, and as you just said, the Federal Reserve prioritizes the stock market for a reason, because they believe that's the primary signal by which consumers and businesses use to set their economic plans. So if you're a business person, you see the stock market booming, you think, well, the economy must be doing really well. I'm going to hire more workers. I'm going to invest more. I'm going to do all those types of activities that help to create economic growth and sustain it. So if the stock market starts to fall because the stock market thinks the Fed is removing the punch bowl, which actually doesn't happen, but psychologically speaking, if investors in the stock market are believing the Fed's taking the punch bowl away, you're sort of damned if you're doing, damned if you don't, right? Because you want inflationary behavior, or you want the supply shock behavior to diminish. And so lower stock prices might help consumers buy less. But at the same time, you're raising rates. Maybe you spoil the party in equities too much, and it goes too far where consumers and businesses get the wrong signal, where they think things are going really wrong, and it spills over into more than just adjusting for consumer prices. Now you're sort of creating the thing that you don't want to have happen, which is consumers get too fearful, stock prices go too low, and then it becomes sort of the opposite self-reinforcing prophecy, where, self-fulfilling prophecy, where businesses actually do start to spend less, start to hire less. Consumers actually do spend less, and it doesn't just back off some of the consumer price pressures. It actually goes too far, and they spend way too much less.
Jeff, I would like to share a claim or a conversation that I had with Nadiv, and I would love to hear what you think about it. So we were talking a lot about interest rates, and the way we understand it, there would be a natural interest rate. There would be one that represents kind of the relationship between capital, I'd say, and the need for capital. And I'm not talking about money, I'm talking about real capital, real availability of resources, and the need for it in the economy. And I feel like we are in such a low interest rate environment, not because of quantitative easing, but because we are in a modern era in which we have so much available capital and so little need for it, or so few entrepreneurs to come and use that capital. Would you say that the current low interest rate environment, would you see it somehow rise significantly? Could you see interest rates rise significantly? Or would you say that because of these conditions, we are not going to see it in any way rising in the foreseeable future?
Yeah, there's a couple of things there that you just said that I think are absolutely crucial to understanding the situation. Number one is the lack of risk taking. That is absolutely the problem here. It's one of the biggest problems that we have is that entrepreneurs aren't taking risks. Big companies aren't taking risks. Small companies can't get credit to take risks. Nobody wants to take any risk. And so that's really the reason why we have low interest rates overall. You're right. It's not quantitative easing. It's the fact that the entire financial system, entire economic system only wants to own safety. They only want to own liquidity. Nobody wants to take risks on taking advantage of all of this innovation and possible technology that are available. We can't get, small and medium-sized businesses can't get credit. And so in one sense, interest rates are also very deceiving. So I think that the natural rate of interest such that one might actually exist maybe isn't what we thought. Maybe what we can piece together from it from what we see from market prices. For example, a small business that's in the service economy in the United States today isn't going to be able to get any credit at all. And so what is their effective interest rates? It's infinity. It's something huge. It's something so big that it doesn't count. It doesn't happen. So the credit that the small business that would take a risk, the price that they would have to pay to obtain the credit is so huge, they never get that credit. But that doesn't go onto a market price anywhere. It doesn't get absorbed on the tape. So Google or Apple, who has absolutely no need for any additional credit, they can borrow at obscenely low rates, but they're doing so because they're managing their own liquidity, not because they're taking risks. So the price of the interest cost for risk takers is through the roof, whereas the interest cost for safe and liquid borrowers is through the floor. But so you have this massive dichotomy, which doesn't get resolved unless you start to think about why is that? Why is the banking system, why is the monetary system only prioritizing safe and liquid investments?
And why is it? Like, it's a question that we keep asking in different forms, but
how do we what is it we're really talking about here? And that's the lack of monetary sufficiency, because we can't depend upon the economy nor these financial markets to act in the same predictable, flexible manner that they did before the crisis. You can't take risks. You can't take illiquid assets onto your balance sheet because the risks of doing so are too high. Remember how the financial system actually works. Everything isn't, it's not just profit seeking, it's risk adjusted profit seeking. So if you think the risks are high, you have to get a huge potential profit in order to make it worthwhile to engage in that activity. That's why a small and medium-sized business in Europe can't get credit. It's why the Japanese are complaining. It's now the Chinese are complaining about small and medium-sized credit, because by and large, the global financial system is risk averse, liquidity risk averse, most of all, because of financial volatility that happens alongside illiquid marketplaces. And so because of that, we have this massive mismatch. It looks like interest rates are low and that everything's fine. There's too much money. Well, there's too much money for the least risky borrowers, right? Google doesn't need any more money, but they can borrow whatever they want. The businesses that actually need money, that could take risk, that could grow the economy in a sustainable way, they couldn't possibly dream of getting credit because nobody will take the risk on them. And that's really, John Maynard Keynes called it liquidity preferences, and he used it in the consumer context. It's no different here. You have to have a risk-adjusted profit opportunity be large enough to engage in a transaction where you give up liquidity. And so if I'm going to give up liquidity to lend money to a small and medium-sized business, it has to make sense to me on a risk-adjusted basis. And if I think the economy is going to be bad for a long time, or if I think the marketplace isn't going to be good, I'm going to charge that risk taker an enormous possible interest rate, too much for them to actually take the credit. And so that whole risk-taking part of the economy doesn't get any money, doesn't get any credit, and that really that stifles really the activities that Keynes called them the animal spirits. That stifles that kind of activity that an economy needs to grow. Big companies can borrow whatever cost that they want, and everybody else suffers for it. But we only see the one part of the equation there.
What do you think are the consequences that big companies, like you mentioned before, Alphabet and Apple, or governments, mainly I would say the U.S. government, they can get as much liquidity as they want. They can, issue as many bonds as they want in these ridiculously low yields. What's the long-term effect on the economy when all this money is going to the government activities and to big established companies and not to startups, to mom and dad, shops. But what do you think the consequences of that would be in the long term?
In a word, Japan, to put it very simply. And that's, you get into the self-reinforcing cycle too, right? If the government is the only game in town, and you're right, that's exactly what happens. Because of this bid for safety and liquidity, because of repo collateral, collateral shortage, governments, especially in the United States, are given this supremacy, this priority in borrowing, where they can issue debt as much as they possibly want at almost any price. And so that creates the perverse incentive where the government thinks, I can do more, so I am going to do more to fix the economy problem. And so government becomes even heavier redistributor of economic activity, which, as we know, is the worst possible outcome because government is absolutely atrocious at doing economic activities. Governments are the worst kind of redistribution mechanism in any kind of economic situation, as the Japanese have proven over and over and over again over the last 30 years. And so we're just following this Japanese case where the governments are the only game in town, or big companies borrow funds they don't need so that they can buy back their stock, which raises their share price, which doesn't help either because it creates the artificial illusion that that things are doing well because stock prices are up. So we're doing all of the wrong things because the monetary system prioritizes still safety and liquidity instead of risk taking.
You mentioned Japan before, and many people argue that the reason Japan is, entering their fourth lost decade right now is that the Japanese culture is somewhat different than the Western culture. They don't accept foreigners. They live longer. They have longer life expectancy. Do you think there's any truth to that, or
no,
or flat out
not
no?
a bit? No, I think that's an attempt to try to explain how we don't end up being Japan when in fact we're actually mimicking Japan very closely in every respect, whether it be GDP growth, whether it be interest rates, whether it be anything. We follow the Japanese too closely, and I think people are trying to self-delude themselves into believing that we can't possibly be Japan because Japan has all of these weird, quirky characteristics, and therefore we're very different from the Japanese. When I think that's sort of the height of hubris, thinking that the Japanese do it all wrong, we'll get it all right when it comes to us.
And we're doing the exact same things. We're doing the exact same things.
Exactly. We'll do the QEs. We'll do the zero interest rate policies. We'll do the heavy government spending. All the things Japan did, and it's sad to think that way, but in one sense, it's deeply ingrained. In fact, the Federal Reserve made that exact mistake in the 2003. They examined how Japanese quantitative easing had failed. They realized in 2003, Japan's QEs had failed. And what they ended up coming up with was, it's the Japanese. The problem is the Bank of Japan did it wrong. When our time comes, we'll do it right. And that's just the amount of hubris that's involved in that kind of thinking. And it's also very counterproductive because you're not actually thinking about the situation as it is. You're already predetermined an outcome, which is we won't be Japan because we won't do it. They did it all wrong. I don't agree with that assessment at all.
In the early 90s, the Japanese stock market crashed, I think, between 80 and 90%. And they suffered from an immense amount of deflation, especially until 1997, when the Japanese central bank got its autonomy from the government. Do you think that's something that's likely to see that type of crash in securities in the American system? I have a few friends who are bankers, and they say to me, listen, today the system is built completely differently, and 80% crash in the stock market is impossible. The Fed will be able to stop it. The Fed will allow it to go down as much as the Fed wants to, maybe 20, 30, 40% if they want to. And they can stop it if they want, because they, I guess, because they have the money printer.
Which we know they don't. And, the Greenspan put the Greenspan put only works if everybody believes in it.
But everyone does believe in it.
Do
you think there's any reason that people will stop believing in it? Everyone does believe in it.
We've seen it twice this decade, or twice this century, right? We had the dot-com crash in 2001. The NASDAQ went down 80%. The S&P 500 went down almost 60%. Where was the Greenspan put then? How about 2000? 2007 to 2009. Again, we had another 60% crash in stocks, two within the space of 10 years. Where was the Greenspan put then? We had the stock market in March of 2020 collapse by nearly 40% in the US.
In 3 weeks.
Where was the Fed then? It's why, okay, as long as people believe in the Greenspan put, yes, there's a Greenspan put, but if push comes to shove, where actual systemic liquidity is impaired, as it was in 2007, 2008, as it was in March of 2020, you'll see the Greenspan put disappear and people stop believing in it faster than anything else.
Guy tells me many times that he will not touch Guy tells me many times that he will not touch government bonds with a broom, that he won't be going to get anywhere near them. And I tend to think that government bonds, although their yield is ridiculously low, as we've spoken before, have quite a high demand when there is a liquidity crunch, when people need collateral in the market. Do you see a run on collateral is something that's bound to happen when there's the next 2008 or 2020 crisis? Do you see a theory? Maybe I would ask it differently. Do you see a theory on holding treasuries as maybe a protection, a hedge against these extreme movements in the market? I would love to hear your thought about that.
Yeah, nothing will ever repeat in history. So we're not going to see another 2008. We probably won't see anything like March 2020, but that doesn't mean we can't go through something different, because March 2020 in some ways was a lot like 2008, but it had its own characteristics too. So, yeah, the question is, what are treasuries for? And I think people have a misperception about the word bubble, and they've associated the word bubble with anything that has a high price. So stocks are in a bubble because they're priced to the moon, right? And that may be the case because there's really no fundamental basis to value stocks. We all tell ourselves it has to do with earnings, and that's just kind of a fiction that it's sort of another fairy tale like the Greenspan put. But bonds are a different story. If bonds are high priced, that doesn't mean they're in a bubble. Yet, like people like to associate with a bubble because the prices are so high and the yields are so low. And so the investment characteristics in bonds seem to be really unfavorable. But you have to ask yourself why that is. Is there a fundamental reason why bond prices could be so high? And you said it already, and we've said it many times over the course of our conversation here: safety and liquidity. Those are fundamental values that would cause the prices of those instruments to go high. Repo collateral is a perfect example. Repo collateral is a valuation for these instruments that has nothing to do with their investment characteristics. Yet they have a value, and at times a very high value and a premium value when liquidity and collateral is scarce and things like that happen. So is there a high enough probability where we go through another period where the safety and liquidity characteristics far in excess of the investment characteristics on government bonds could cause their prices to rise again, or even go further in some places? And I think the answer is unequivocally yes. And I think that's the message the markets are sending us as we speak today. The Federal Reserve is hiking rates, which is supposed to be really bad for fixed income instruments. Yet we see, the yield curve flatten out, which means longer term treasuries are, they're falling in value, but they haven't fallen in value all that much compared to where they quote unquote should be, given these rate hikes and given inflation and growth prospects that are at least talked about in the mainstream media. So already the markets are valuing those instruments above and beyond where they should be valued given their investment characteristics. And if things do start to go in the wrong direction, if the yield curve is right, if the Eurodollar futures curve is right, we do head into a downturn, maybe in recession, what is that going to do for demand for safety and liquidity? It's going to raise the demand for those things, especially
there's going to be a huge short squeeze on bonds. If that happens, there's going to be an immense short squeeze on bonds.
And that's before we even get to the collateral considerations, which we don't really have enough information to make a really informed judgment about how scarce collateral is at the current time, how many times it's been reused and repledged, and therefore how much potential there is for imploding. So, the market is sending all of these signals to us that tells us that there is value in safe and liquid instruments above and beyond their investment characteristics. Even though it sounds like it's a bubble, it's probably not a bubble, because there are fundamental monetary reasons, financial reasons, potentially economic reasons for owning safety and liquidity. So, and that's right now where things are, relatively sane. And if we do get closer to a recession, then safety and liquidity, the demand for those, collateral scarcity, all these things combined, we could see those prices go higher.
Yeah. If I'm trying to think as a politician, and I see a situation where the economy goes into a recession, there's a scarcity of bonds, bond prices go higher, I would like to issue new treasuries, new debt to the public and actually create quite a bit of inflation. So it seems to me that this deflationary thesis actually leads to quite a bit of inflation when that day does come and everyone is running to buy safe and liquid government debt. What do you think about that?
Yeah, I'm not sure I follow you there. I mean, so you're saying we get a deflationary event that leads to an inflationary event? It's sort of the thesis. I forget who it is. Ray Dalio, I think it is, who says that we go through the deflationary crisis that leads to governments coming in and just going nuts and actually printing money. I'm not sure I buy that.
Allowing changing the rules, politicians changing the rules, like the Federal Reserve Act, and allowing the Federal Reserve actually to give out helicopter money straight into the economy.
Yeah, and I think there's a wide variety of commentators who believe that that's the eventual outcome, that we go through enough of this deflationary stuff, and finally, whether it's MMT, whether it's some other form of, as you said, changing the rules, governments get the inflation that they supposedly want. And I remain unconvinced, because as much as that is maybe theoretically the trend that we want to think in terms of what would politicians do, it seems easy. It seems like the path of least resistance would be to just change the rules and let inflation fly. But I don't think it's that easy at all. In fact, I think you have to sit back and think, well, how does the monetary system actually work? And it doesn't work in a manner that allows governments to just flip a switch. It's the banking system that flips the switch. And as long as the banking system is the money, then we're kind of stuck with the banking system as it is. And unless the governments are going to change the rules about how the monetary system actually behaves and what it's constructed, basically reforming the system from the ground up, then we're kind of stuck with the situation that we have now. So I'm less convinced about the inflationary end of the Eurodollar, let's say, and I'm more worried about being stuck in this same perpetual state for more like Japan lengths of time. Can we go into a fourth lost decade? Well, yes, we can. In fact, we're already halfway through the second lost decade. And so it can go a lot longer than maybe we think it can. But there's always, if governments are getting to the point where they think they have to change the rules, then maybe they're the state where they realize that we have to do something about the current problem. And at that point, maybe they actually pinpoint what the problem actually is and can actually fix it before they just go hog wild printing money in whatever form it might be. So even then, in my mind, there's a better chance of maybe fixing things and getting out of it than there is, this utterly uncontrolled hyperinflation down the road.
How would that come out? Because you seem to be pretty pessimistic about the future.
I'm pessimistic about the near term, but I am incredibly optimistic about the long run.
So
I think that gets lost.
Yeah.
And I think at some point that actually happens. Enough people start to say, hey, this Eurodollar thing is the thing that's holding us back. And if we fix the Eurodollar and get out of the friggin' way, the economy will grow.
How do you do that? How do you fix the Eurodollar? How do you change the system? It's like changing the internet. It's how do you change a system that's so old and so interconnected?
I would ask a different question before that. Like, how would that system look like? Like, putting aside how we would arrive there, how would a different system that works well would look?
I think we've actually found some of the answers already. And, to answer your question or your comment first, Nadiv, it's more of, we're seeing digital technology. Like you said, how do we change the internet? Well, the internet's already been changed. It's in the process of being changed for the second time. We're getting into Web 3.0. So it's not an impossible task. And there are many smart people who have invested time and money and resources into doing it. It can be done. And I think a digital currency format is exactly the answer we're looking at. We're not there yet. The technology hasn't evolved yet. But you think of things like algorithmic stable coins, for example. An algorithmic stable coin is a stab in the right direction, because an algorithmic stable coin is something that seeks to match the demand for money with the supply of money, which is what we're supposed to be doing here. Money demand is supposed to match money supply in the most efficient and flexible way possible. That's what a good system does. The problem with the Eurodollar system was that it just threw money at everything. There was no efficiency. There was no discipline. And so you had money creation far and above what was actually legitimate and far and above what would have actually been sustainably efficient. That's where the system went wrong. And so it's not so much, do we have a technological problem? It's more of a design issue about managing demand for money with supply for money. And so I think there are any number of ways, I think there are any number of potential ways to do so, where we could overlay a digital currency system on the existing Eurodollar infrastructure in a way that was like Internet 2.0 going to, or Web 2.0 going to Web 3.0. It is absolutely possible. And of course, I'm glossing over all the incredible complexities and I'm making it sound easy and ideal, but I do think there's a pathway forward where we use something like that kind of technology to solve the solution. And of course, there's any number of headaches and problems and impediments along the way too, because central bankers are not going to want a private digital currency system to replace them. The banking system is going to raise holy hell,
want it,
because they're not going to want to give up their privileged position being the Eurodollar bookkeeper. Governments are not going to say, hey, governments actually believe that they're in charge of currencies when they're not. And so they're going to try everything possible to maintain this illusion of control over money, because that's what governments do. So it's an incredible, big, huge challenge, but I don't think it's impossible. And I think as the longer we go down this Japanese pathway where the whole global economy suffers and we suffer the social and political consequences from it, eventually we get to a tipping point where enough people say, we got to do something different. It doesn't matter what governments are squabbling about, or banks don't want to do this, or central bankers it doesn't matter. We've got enough sense of urgency that we can create a private solution to what is really a private monetary problem to begin with. I think that's down the road a ways, but that is one reason why I can see that there's potential here. And I do think eventually this does get solved. And when it does, I'm incredibly optimistic for that day. It's just getting from here to there. That's the problem.
This tipping point event might be a catastrophe that would make the change that can happen in the system. Like we know how politicians are, or just how human beings are. We don't make changes very quickly. We need dramatic events to make us rethink about the way we live and the systems we have around us. And I'm quite afraid that this growing financial stress all over the world can cause a lot of tension. It can cause wars. It can cause poverty. We saw, the end of the Great Recession, the Great Depression, World War II, the Holocaust. We saw terrible things that happened that have a fundamental financial basis to them that is widely ignored, I think.
Well, two sides of that coin, right? As you're just saying, Bretton Woods was the monetary system resulting from the worst of the worst case, World War II. You had the Great Depression, you had the financial and monetary drag that became an unsolvable economic problem, leading to the worst conflict in human history and all of all the tragedies that went along with it. And out from the ashes of that, that's where we got Bretton Woods. So you could say, yeah, that's one possibility. We need something really bad to happen for a workable solution to happen. But the other side of that was Bretton Woods did not work very well. In fact, it only lasted about 16 years before it defaulted. And so you get to 1950s, 1960s, the Eurodollar system comes along and hardly anybody knew it took over the roles of the reserve currency. So it was sort of a seamless transition that did not require all of the violence and all of the destruction of the previous one. So yes, you're right. The risk is we could do the World War II Bretton Woods path, but there's also a chance we could avoid it and do the 1959, 1960 Eurodollar path, which is not necessarily as violent, not necessarily as disruptive and messy. The trick is, as I think as you're both alluding to here, is how do we get people to realize we need to do this before it's too late to do it?
We interviewed Jeff Snider.
That's the trick.
That's how we do it. We speak with Jeff.
Yeah. If that's the case, then we're screwed. we're already screwed.
I'd like to ask if you manage to consult central bankers, the Fed, if you have any interaction with people who are in these key positions, are they becoming aware of this system?
Yes, very, very slowly. I interact occasionally with politicians, sometimes with central bankers, sometimes with officials, and their understanding is still very primitive, but they've come to realize, especially I would say in the last 3 or 4 years, 2018 was sort of a breaking point where, up until then, everybody was willing to just give the Fed the benefit of the doubt because, 2017 things seemed like things were going right. And then everything went wrong in 2018 and 2019. And everybody's like, what the hell's going on here? And so there's a little bit more of an open door in the official, in the official sector where willing to understand that collateral plays a huge role. And that's including inside the Federal Reserve, inside the ECB and places like that, where they're starting to think more dynamically than just exclusively about bank reserves. Politicians are starting to get the sense that maybe central bankers are not the end all be all of all these things, but it is incredibly slow. It is incredibly incremental. So it's not like we should expect them to be up to speed to 2008 anytime this decade. It may take, again, there needs to be something that creates some more urgency for them to go beyond. But it is interesting to see, whether it be academic scholarship, whether it be just, conversations where, for example, the term Eurodollar has been thrown around a hell of a lot more frequently over the last year or so than it had ever been previously. So there's sort of this slow motion awakening to this global monetary reserve system. And the question is it moving fast enough because the clock is ticking? Can we get to that place where everybody's urgent, everybody has enough urgency, realizes we need to do something different before we end up getting into the Bretton Woods type of situation?
You have a big mission.
Yeah.
A lot of responsibility.
I'm still, that's why I love these conversations, because we're still stuck on step one. I say, before we even get into figuring out what the solution has to be, we need everybody to realize what the system actually is and what it has been for 50 years. So step one is looking backwards at the history of all this stuff, looking backwards at, the 2008 crisis and realizing it wasn't subprime mortgages. There was a global dollar shortage. And here we are in March of 2022. We're still on step one, which is people still don't realize how it actually works. They still believe QE is money printing. They still believe the Federal Reserve is a central bank, all of these things. Tomorrow's going to be another reminder of that, because everybody's going to fall over themselves talking about the Fed's rate hikes when markets and money and everything else is going. So it's an enormous, tall task, but I think, it's you guys agree, it's one that we need to do, and we need to do collectively. The more people we can reach and get involved and understand what the situation is, the more likely we create that critical mass and get to a reform point before we go too far in the other direction.
When are you going to write a book, Jeff?
See, the problem is the real book would have to be a sequel to this, which
is 300. How many episodes are you and Emil on now?
We're on 200. This is Milton Friedman's A Monetary History. This is what he wrote to reform the monetary understanding in 1963, and that's what it really would require. I am working on a book, by the way. It's not going to be that. It's going to be a slimmed down version where I hope to do exactly what we're doing here today, which is to give people enough of the story that they get interested in it and want to go further. So it's going to be a sort of a condensed version of the Eurodollar, ledger money, what's collateral, repo, all these modern money stuff, what really happened in 2008 without it being, 1,500 pages of, full of annotations and things like that. But that's what really needs to be done, is something like that.
Can I ask you a bonus question? Because I feel like we've been going for a long time.
Sure, why not?
I think in one of your episodes, you kind of mentioned or hinted that banks in the shadow system can actually print money in ways that they're not supposed to, and just have it off the books, or kind of just play around with the numbers. Can you please speak about that?
Oh boy, this is a longer topic.
Guy came when we talked about this the first time. Guy and I, we said, "Oh, maybe we should just buy a bank." Why should we be working so hard to just buy this bank somewhere in Turkey?
If you can make money out of thin air, right? Then why are we all banks?
Are there people who are actually making money now out of thin air? Period.
So the problem is you can't just open a bank and say, I'm printing money out of thin air, because this is essentially a game of confidence and trust. So if I go to the Cayman Islands, because that's where a lot of Eurodollar bank, if you go to the Cayman Islands, by the way, there's no banks there. There's a bunch of accountants and lawyers and names and post office boxes, but there's no actual physical banks there. So why can't I just go to the Caymans, put a name on a door, hire a bunch of accountants and attorneys, and call myself the Jeff Snider Bank and start printing money from nothing? Well, because I have to connect with other banks who have to accept me into the club, essentially. So if I go to the Caymans and open my bank and start printing money, nobody's going to transact with me because it's nothing more than funny money. If I go to the Caymans with a letter of credit from, say, Goldman Sachs, I'm suddenly welcomed into the club. Then I can do what other banks are doing.
That's my question. Does that actually happen?
Sure, happens all the time. It's happened for decades. So what happens then? Because there is no money in the system, it's entirely a ledger money system. It's all numbers on a paper, actually numbers on a computer screen. The only rules are your internal guidelines for how you manage your book. Because remember, you're a profit-seeking firm who doesn't want to go out of business. So you have to put some form of constraints on your balance sheet, which means traders have to be given some constraints. Otherwise, they're going to put you out of business. They'll just do risky trades and you'll lose money and you'll be bankrupt in a day. So there are internal constraints that you have to adhere to. There are also external constraints, because let's face it, if you want to get in the repo market and borrow in order to fund all of these positions that you're going to put on, you have to have good quality collateral, which means you have to have connections to collateral. You have to have connections to other banks. So it's not as simple as just going into the Cayman Islands, starting your own firm, hanging a shingle out and just printing money. There is some complexity involved, even though when you get into the Eurodollar system and you're one of the accepted group, that's kind of what happens. You essentially do print money on your balance sheet, but you got to get there first. And it's not as easy as it sounds.
Yeah. So it's just amazing to think. Oh, yeah, Guy.
So what does it mean? Like if Nadiv were accepted to this luxurious club and Nadiv now wants to print money, like banks don't actually like print money, so they lend a certain portion of their bank reserves, of their deposits. They can lend a certain amount out. So like, how would Nadiv print money, or how do these bankers use this system?
You don't actually print money. You don't actually print tokens. There's no physical tokens here. It's just a number on a piece of paper. So what happens is essentially, you're a company, you want to borrow money from me. I don't have any money to give you, but I pretend that I do. So what happens is I write down that I now create a deposit liability for you. I have a deposit liability, and I offset that with an asset, which is cash or cash equivalent. It's not physical cash, but it's a cash equivalent, which then you can use as actual money. It's nothing more than fractional reserve depository banking. There's no, except we don't actually have to have the physical currency backing it out. We don't actually convert. There's no convertibility in the system because nobody wants the physical cash. And so it's a reserveless system where we're still doing the same things as a fractional reserve system, just we've eliminated the need for reserves. So we're still creating deposit liabilities. We're still creating loan assets and things like that. We're still creating foreign claims and local claims and all these other things, as if in a fractional reserve business or fractional reserve bank, we've just eliminated the reserves. And so there's no physical money because nobody wants to convert their liabilities. You know, if I'm a deposit holder, I don't want to convert it into physical cash because that's cumbersome. That's inefficient. It's much easier just to stick with this ledger money system. So it's a reserveless system that operates in the same fashion. It's always been at the stroke of a bookkeeper's pen where money gets created in those types of situations. The distinction here is that there are no reserves.
Guy, I think we opened the wrong business.
We all did.
We should have gone to the banking industry.
The problem is you got to swim with the sharks in that situation. If you want to open a bank, then you got to go into it with all the rest of them, and they're all looking to put you out of business.
Okay, Jeff, it's been really a pleasure and an honor to have you on our show, have you speak with us. We've been on for almost 2 hours now, so it's been incredible. So thank you so much. We're really hoping to have another chance with you, maybe in a few months or a year or so. Thank you.
Yeah, my absolute pleasure. And like I said, I enjoy the conversation. I'm always glad to have the opportunity to talk, especially to a new audience. I wish I knew a little bit of Hebrew. That probably would have helped.
Shalom.
But unfortunately, I'm English only.
Okay, so send regards to Emil.
I will. Thank you, guys.
Thank you very much.
Cheers. Keep doing what you do. All the best.
Take care.
Cheers.